Hello everyone and welcome back to Trader DNA. In today's video, we will dive deep into one of the strongest supply and demand areas, known as the order block zone. This area holds significant importance in understanding market dynamics and can provide a strong foundation for making informed trading decisions. By watching this tutorial, you will learn how to accurately identify order block zones on the chart, and, most importantly, the rules to confirm whether an order block is valid. Mastering this technique can greatly enhance your ability to spot potential trading opportunities, reducing unnecessary risks while improving your overall strategy. So, make sure not to skip any part of this video if you want to gain the full benefit of this exciting concept. Stick with us, and by the end of this session, you'll have the knowledge and skills needed to apply order block identification confidently in your trading. So let's begin with the basics. What exactly is an order block? An order block is considered one of the most powerful areas in technical analysis, believed to be a footprint of supply and demand left by large financial institutions. These zones are formed when central banks or other major financial institutions accumulate massive amounts of a particular asset. They place exceptionally large orders, which result in strong price movements, what we refer to as impulsive price action. This occurs because there is a significant imbalance between the number of buy orders and sell orders, causing sharp and rapid shifts in the market. But why is the order block so important? The reason is quite simple yet profound. The order block represents the trace of institutional orders, and when the price revisits these areas, we can anticipate that the same buyers and sellers who initially created this zone will react once again. This often leads to a significant price response, where the market either reverses or bounces off these levels with considerable strength. Understanding how to spot and use order blocks can give traders a critical edge by following the footprint of institutions, which are the key players driving major market movements. So in a bullish market, the last bearish candle before an impulsive upward movement is marked as the demand order block. This candle acts as the starting point of a strong price push, and identifying it is key to understanding where institutions place their large orders. Alternatively, if you see a small green candle just before the price surges upward, this candle also represents the order block. It doesn't necessarily need to be an engulfing candle to qualify. In this case, you would mark the area down to the support level, or highlight just the small green candle before the impulsive move. The same concept applies in a bearish market. The last bullish candle before an impulsive drop is marked as the supply order block. Similarly, a small red candle just before a strong downward movement can also be marked as the order block. If the order block isn't engulfing, you can either start marking from the last green candle or just highlight the small red candle before the price plummets. Mastering this technique of identifying order blocks, whether in a bullish or bearish context, will give you a solid foundation for understanding how institutional activity influences market movements, allowing you to trade with greater precision. Now, let's take a look at an example on this chart. Here we're going to train our eyes to spot order block areas. The first thing we notice is the impulsive movement in the market caused by the imbalance between the number of buyers and sellers. Now let's apply the order block principle based on the definition we just discussed. Specifically, the last green candle before an impulsive drop and the last bearish candle before an impulsive rise, this would haze, or the first small candle before the impulsive move. In this case, we can see a bullish candle before the market makes an impulsive move downward, so we mark this area up to the tail of the following red candle. Then we observe another green candle just before an impulsive downward move, so we mark this as well. We can also see the last bearish candle before an impulsive upward movement, so we mark this area too. This same approach applies to other small red and green candles that precede impulsive movements on the chart. As you can see, prices often bounce off these marked areas, indicating that there is still significant pressure from buyers and sellers at these order block zones. At this point, you should have a good understanding of the basic concept of order blocks. However, there are a few more key points to keep in mind. There are 4 rules that need to be met for an order block to work effectively and have a high probability of success. These criteria are 1. An impulsive price movement, 2. A break of structure, 3, the presence of an imbalance. And 4, the area must be unmitigated, meaning it's still fresh. So far, we've covered the first rule about impulsive price movement. Now, let's move on to the next rule, the break of structure. Now, let's take a look at this example on the chart. Here we can see that the price moves downward, pauses, and then reverses upward from this point, forming what we call a Q-level structure at this spot. After that, the price drops sharply again, creating an impulsive movement. However, the candle in this instance is not an order block, because the price did not break below this structure. For an order block to be considered valid, the price must break through the structure, or, in other words, there must be a clear break of structure. Without this, the order block cannot be confirmed, and the setup lacks the necessary confirmation for high probability trading. The third rule is the area of imbalance. Let's take a closer look at this example. Here we can see a similar formation of impulsive upward candles. However, when I add the wicks of the candles, you'll notice a key difference. On the left, the price moves upward to this point, then pulls back, filling all the limit orders that were waiting for a pullback. If we identify this level as an order block and expect the price to react at this area, the chances of it working are low because there are no remaining limit orders left. All of the orders that were waiting to be filled have already been executed during the pullback. Now let's focus on the scenario on the right. If institutions were aggressively buying and the number of sellers was significantly outnumbered at this level, the price would move upward impulsively, leaving behind unfilled buy orders. In this case, those buyers who didn't get their orders filled will likely wait for a pullback to re-enter at this price level. As a result, institutions that couldn't acquire the asset will place limit orders around this area, anticipating a future pullback. This is the concept known as imbalance, where there's an unequal number of buyers and sellers, leaving unfilled orders at a certain price level, which increases the likelihood of price returning to that area to fulfill those remaining orders. Now, let's move on to the final rule, which is very straightforward. The order block must be unmitigated, or in other words, still fresh. Order blocks should ideally be used only once. If the price has already reacted to the order block in the past, it's better not to enter again on the next touch. I'm not saying the area will definitely fail, but it will have a lower probability of working out compared to a fresh, untouched order block. That's why it's essential to focus on unmitigated areas. Order blocks that haven't been interacted with yet, because they offer higher potential for a strong price reaction and therefore a better chance for success in your trades. So, now that we've covered the 4 key criteria that must be met for an order block to be valid, let's apply them to the chart. Here we can see a clear downtrend. As we look closer, we spot an impulsive movement, a break of structure, an imbalance, and the area is still fresh. Therefore, we can mark this candle as a supply order block. Next, we see 2 more order block areas, both followed by a break of structure and impulsive price movement. There's an imbalance present, and both areas are unmitigated, meaning they haven't been touched yet, so we can mark these areas as well. We also spot another valid order block here, which we will mark accordingly. Notice how the price tends to bounce off these areas. However, not every order block will be respected by the market. It's important to remember that order blocks are areas of high probability, not certainty. Some areas may still get breached, but focusing on these key zones can give you a stronger edge in your trading. Now let's shift our focus to an uptrend. Here we can clearly observe an impulsive movement, an area of imbalance, and a break of structure. This leads us to identify the last candle and the small green candle before the impulsive move as the order block area. Some traders may also refer to this as a rally base rally, but it's just a matter of terminology. What's important is that we recognize this zone as a point where there was significant buying pressure, causing the price to shoot upward and break through the structure. Then, and once again, the price experiences a break of structure, another impulsive movement, and we can see an imbalance. Below, we spot a small red candle and a green candle right before the price surged. Since this isn't an engulfing candle setup, we could simply mark the small green candle. However, I prefer to combine it with the red candle, so I mark the entire area from the red candle to the small green one. As the trend continues, we see another impulsive movement followed by a break of structure and an imbalance. Just below this move, we observe a red candle and a small green candle before the impulsive move. So we mark this area as another valid order block because it remains unmitigated. It's still fresh and hasn't been touched by price. Now notice how the price bounces off this area, reacting precisely as we expect from a fresh order block zone. Now to summarize, these are the 4 key rules you need to remember when identifying a valid order block. 1. The price creates an impulsive movement. 2. There is a clear break of structure. 3. An area of imbalance is present. 4. The order block is unmitigated, or in other words, the area is still fresh. However, remember that there will be days when the order block fails, and that's why it's essential to always apply proper risk management and remain consistent with your strategy. For more details on entry strategies, you can check out our previous content, which I'll link at the end of this video. That's all for today's lesson. Now I kindly ask you to take just a few seconds to hit the like button, subscribe, and turn on notifications. It may seem like just a few clicks, but it truly makes me happy, and in return, you'll always stay updated with the latest content from this channel. Thank you so much for watching until the end, and I'll see you in the next video.